Welcome to the Commercial Real Estate Show, your source for market intelligence, forecasts, and success strategies. Hello, I'm Michael Bull. Thanks for sharing your time with us. Maybe you're on the radio, maybe you're on YouTube, iTunes, or the show website, creshow.com. Well, we have a fun show for you today. We're talking about multifamily. We're going to look at how 2016 wrapped up. We're going to look at what to expect in 2017. We're going to look at cap rates. We're going to look at rental rates. We're going to look at the factors that may impact multifamily. We'll also look at maybe how Trump presidency will impact multifamily. We're also going to look at multifamily REITs and what to expect moving there. And then finally, we'll share some tips on buying and selling apartments in the current market. Please welcome my first guest. It's Jay Parsons. He's VP of MPF Research at RealPage, and he's joining us on the phone. Jay, thanks for being with us.
Thanks for having me.
Well, Jay, it seems like the multifamily market's almost surprised a lot of people that year after year it's just seemed to keep growing, increasing rents, improved occupancy numbers. So how did 2016 wrap up?
Well, 2016 certainly wasn't as hot as 2015. And if you're a glass half empty person, you look at that, you say, hey, we're past the peak. The market is slowing. But if you're a glass half full person, which I would tend to call myself, and you look at today or 2016 and you say, hey, maybe we're past the peak, but if you don't think these numbers are good, then you have a skewed sense of what's normal or average.
Yeah, that's interesting. So how much did rental rates improve in 2016? What was the trend there?
Well, on average throughout the year, we recorded year-over-year same-store effective rent growth of about 3.6%. Now, having said that, the spectrum of results has grown materially, meaning that you are seeing some negative numbers in certain markets, certain segments, and you're still seeing some very big numbers in other spots. So that the spreads between the top to bottom markets have gotten a lot bigger than prior years.
Okay. So, Jay, is that spread more on markets, on cities, or is it also on class, say A versus B and C?
Yeah, it's really both. Certainly the A market, particularly in urban locations where so much of the construction is concentrated. Michael, as we talked about before, we're building at a pace in downtown submarkets across the country that is really unrivaled going back to post-World War II. And so that is having a dramatic impact on rent growth in the downtown urban core submarkets across the country, particularly the Class A space. You look at some of the late recovery markets across the country. Think about places like Vegas, Phoenix, Sacramento, Atlanta, still seeing some great growth. And then just generally speaking, we still continue to see strong rent growth in the suburbs across the country, as well as in that Class B segment, which seems to be really positioned well, given the high price point for new supply in this cycle.
You're right, and we're not typically building new B product, right?
No, you can't build B product, and people complain about this all the time from the outside. Yeah. But what they don't realize, and as you well know, developers, you can't pencil out a Class B deal. It just doesn't work, and the only way to get a non-Class A type product is to get tax subsidies.
So overall, 3.6% rental rate growth across the country. What about occupancy?
Occupancy, we saw a little bit of backtracking in Q4, about 40 basis points. We're right around 96.1% on average for the country. And given the volume of supply that completed in Q4, which was the biggest Q4 volume in more than a decade, we were concerned that perhaps there'd be further backtracking occupancy. But the good news is that there was still some demand in Q4, which was good, because Q4, as you know, is a seasonally weak demand period. Not a lot of people looking for apartments or homes in the winter months.
So you've seen some average rental growth rate that would correspond with those rate growth around the country?
Absolutely. Again, it's different by sector or segment of the market and by metro, but certainly we're still seeing some good growth for the market overall.
And then multifamilies seems to always be a sweetheart investment property type around the U.S. So what do you see for cap rate trends in 2016 in the multifamily sector?
Yeah, the data we get from Real Capital Analytics shows that cap rates continue to see a little bit of compression. So we're getting into that mid fives range, which is the lowest since they started tracking commercial real estate and multifamily back in 2000, 2001. And, anytime you say cap rates are at record lows, people get nervous. But, you have to remember, of course, that, yields on any investment these days are low compared to historical norms. And obviously the baseline treasury rate is still low. People talk about rising interest rates, but, let's be honest. I mean, the increase we've seen so far was extremely mild, and no one's really projecting significant growth in interest rates anytime soon. So the key thing is that those spreads remain attractive.
Right. And, mid 5 cap. So before you call me and want me to sell your B or C product for a mid 5 cap that's in a secondary market, no, that's averaging, some of the Class A products, right?
Absolutely. That's a good point. I mean, certainly as you look at the garden sector or segment of garden properties, you're still north of 6%. And obviously in most of these markets across the country outside of the big markets, we're still seeing cap rates north of 6%. Even in places like Atlanta, Dallas, and other large markets, I mean the average cap rates haven't fallen in line with the national average because you have a bigger share of that B product that's been very attractive to investors.
That's right. So what do you expect moving forward in 2017, Jay?
Well, looking at 2017, I think that there's really a wide range of possible outcomes, and I hate to sort of hedge, but there's so many factors at play this year and so many uncertainties of how the year will play out. If you assume that we're going to continue to see at least moderate economic growth, and you can make a case that it's going to be less or more, but let's just assume you continue to see good, solid but not spectacular economic growth. I think apartment demand is going to remain very strong. Obviously beyond the economy, we have very favorable demographic trends still. And I think if that occurs, again, strong demand probably won't keep in line with the record volume of supply in 2017. We're going to peak this year, so I think this will be the first year and since the recession where you have a little more supply than demand on a macro basis. That again, that's primarily going to impact the Class A and downtown submarket space. I think that you look at the Class B sector and kind of the C plus, the real heart of the apartment market. And as I mentioned earlier, that stuff is really well positioned. There's low vacancy, there's strong demand for that type of product, and it's really hard to move somebody out of a B unit into a Class A unit in this cycle particularly because the spread between an A and a B in terms of monthly rent is higher than ever. We're seeing, and on a national basis, it's 45 to 50% higher to live in a Class A apartment. So, you can't offer enough concessions for a lease up to pull people out of a B in order to make that work.
Right, and affordability becomes an issue. So you expect occupancy or at least rental rates to continue to grow about the same pace as last year then? Or?
We're calling for rent growth about 3% on average, so a little bit further compression, again, primarily driven by the urban core and lease-ups. We're expecting occupancy to settle in the mid-95 range, which is still fantastic on a historical basis. But, Michael, the big thing I'm really concerned about, I think that can make this result less than the 3%, is there is a concern that I have that apartment managers, operators are going to get a little too jumpy about, macro level slowing, particularly in the urban core. And if you have property managers who manage assets in urban areas with next to lease-ups, they also have suburban portfolios and Bs. And when they start to see slowing in the urban core, there's a tendency to then kind of overreact across your portfolio. And, you have little anecdotal stories of somebody comes in a leasing office, complains about the high rent and says they're moving out. And, a year ago you say, okay, whatever, I got other people who want to live here. And when you start to feel a little bit of nervousness, you start to, overreact in those situations. And we're seeing a little bit of that in the second half of 2016. And I think if operators aren't guided by their internal fundamentals in 2017, they start to let kind of the old sentiment guide things a little bit. I think you could see some additional softening that bring rent growth down even further.
Yeah, well, they also need to watch your software, right? That's adjusting the rental rates for them on a property by property basis every day, right?
Absolutely. I mean, we watch that closely in YieldStar revenue management. The acceptance of rates and there's a tendency sometimes when the market shows a little bit of softening to want to revert back to sort of manual mode, and we've seen time and again it tends to to end poorly.
Right. And Jay, I want you to stay with us over the break because I want to ask you about cap rates moving forward in 2017 with rising rates. Also, if there might be some impact on the multifamily industry from a Trump presidency. So stay with us. We'll have more on Multifamily 2017. I'm Michael Bull. This is the Commercial Real Estate Show. Stay with us. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out creshow.com.